All right, welcome. My name's Stephen Nagy, and this is the Become Your Own Banker Infinite Banking Concept, privatized banking, what we call the 90-minute presentation. Now, I can promise you, if you're on right now and you're like, oh, 90 minutes, it'll fly by, I promise, because we're going to have some fun along the way. And I guarantee you'll learn something new. I see a lot of people on right now that have probably seen this 10 times and they're back. So it just tells me that every time we do it, you learn something new and you got to hear it multiple times to really understand it. So we got a bunch of new people on. We got some people that have been following along for a while. So let's have some fun here. So first off, I'm going to get into a lot with you here tonight, this evening, this afternoon, whatever coast you're on right now. I'm over on the East Coast myself. So you'll see that link right there. You guys are going to want to go there and put in your name and email, and it will automatically send you some additional books and resources. But more importantly, it's going to give you my call calendar and my contact information. So you can see my cell phone on the screen right here, my email address, because after this is done, I'm sure you're going to have questions. I'm sure you're going to want to talk about your personal situation, and I'll answer as many questions as I can here tonight, but I'm sure you're going to want to schedule a phone call with me. So what I want you guys to do is go to that link right there and it'll get my call calendar, and let's schedule a call. Now, I'll give you a heads up. I'm going to be gone for the next week, through next week, 4th of July week. I'm going to be out of town, just going with the family up into the mountains. And we're just doing a little family vacation road trip. But I promise you that I'll get call scheduled. If we got to do something tomorrow or something Thursday before I head out of town, just send me a text message. But definitely go there. I'll monitor it. I'll reach out and we'll get something scheduled. Okay. So what we're going to do tonight is, like I said, we're going to talk about the infinite banking concept and how you can become your own banker. It's what BYOB is all about. But more importantly, how to take back control of your money and solve your money problem. And we're going to talk a lot tonight about money and opportunity, how money flows, what money is, what the, and a lot of us are aware right now what's going on with the markets. Everybody's kind of paying attention to the stock market. I saw the Dow fell almost 500 points today. The NASDAQ was down almost 3% today again. So we just continue to kind of have these losing days in the markets. And I'm sure a lot more of that. A lot of people are expecting that we will be in an official recession next month when the new numbers come out. But a lot of us feel we're already in a session right now. I saw a senator come out last week and he said, when people are struggling to, afford to fill up their gas tanks at the pumps, that kind of tells us we're already in a recession. And I know that's what a lot of people are going through right now. Inflation's through the roofs. One of my coworkers that I work with was telling me today that her, literally just from last week to this week, her propane bill went up something like 32% or something. So everybody's being affected by it. Nobody can escape it. So how do we fix that? How do we not allow that to affect our finances? And more importantly, our retirement and our family's futures. And so tomorrow, Chris and I are going to dig in deep on what's going on with the markets, what's going on, what's driving all of this right now. And we're going to start coming up with a lot of solutions to things you can do right now to take action. So make sure you join us tomorrow on What the F Happened at 9:30 a.m. Eastern. It's live streamed on the YouTube channel and all over social media. And then the Wealth Webinar Wednesday at 1 p.m. Eastern tomorrow. So make sure you hop on those. And we're going to get in deep. But tonight is all going to be about your foundation. And the foundation is where you warehouse your wealth, where you warehouse your money. And I'm going to start showing you here tonight why traditional savings accounts, why going to the bank and giving the bank your money is not the solution. What we want to do is we want to put our money in our own bank, because I'm going to show you a few different things tonight. Number one, I'm going to teach every single one of you, if you have debt, how you can eliminate your debt quicker than otherwise possible while continuing to build wealth for you and your family for the future. Number two, I'm going to show you how to get back all of the money for major purchases, things like vehicles, cars. Okay, so I'm going to show you how to get back all the money for every car that you'll ever buy, drive, and own in the future, and how to start recapturing all that money that right now you're giving away to other people. And number three, I'm going to show you how to, without working any harder, without working any longer, without taking on any more risk, how you can literally multiply your money and start building wealth without doing anything different than what you're doing right now, except where your money goes first. So instead of those traditional means like checkings and savings accounts at Wells Fargo and traditional banks, how you're going to start putting your money in your own private bank, how you're going to become your own banker and take back control of all of these banking functions in your life. And by doing these strategies, it's going to allow you to literally multiply your money and start building wealth without doing anything longer. Now, I got to give a shout out to a couple of my mentors. So Brent Kessler is the founder and owner, CEO of the Money Multiplier. So Brent is my broker in all of this, and he has taught me more than probably anybody else on this specific subject when it comes to becoming your own banker. Brent has something like we'll talk a little bit more about Brent as we get going. But if you want to learn more about Brent and his story, highly suggest going over to the moneymultiplier.com. There's a plethora of resources on there and trainings. We just came out with like 100 new trainings that are on there. So definitely check out the moneymultiplier.com. And if you're here right now tonight on this webinar training, I'm sure you guys know this guy, Chris Naugle. So Chris Naugle, one of my business partners, one of my good friends, and he's known as America's #1 money mentor. Chris spent 16 years in the financial advising and financial planning space before getting into real estate investing, launching his own television show on HGTV called Risky Builders, has flipped over 260 homes, a large real estate portfolio, and also does a lot of what I'm teaching you here tonight in the privatized becoming your own banker space. So Chris's mission is to get out there and work from 5 a.m. to midnight, 7 days a week, and travel around the country teaching these strategies and these concepts. And Chris, you're right, Todd, is an absolute rock star. And I am honored to call him one of my very good friends. So when I first met Chris, that quote that's on the screen right there was something that Chris was talking about from stage. And Chris says, it's never about your actual resources. It's about how resourceful you can be. And that really resonates for me because I came from a real estate investing background as well. I was a personal financial advisor myself also before getting into the investment and entrepreneur space. And what I found over the years, over the last 14 years of working in this industry and being a consultant and doing a lot in business and entrepreneurship and working with students and clients all across the country in all 50 states, is everyone has a money problem. And let me explain what I mean by that. Because a lot of people, they have a lot of debt, or they're living paycheck to paycheck, or they're doing well financially, but the more money they make, the more money that goes out the door, right out the window. And at the end of the day, they don't have any actual wealth built up, right? You can make a lot of money, but it all goes out. So maybe they just don't know where to go and they're struggling right there. And then I've also worked on the other side of the fence with many clients that do make a lot of money, that have a lot of money, but they don't know what to do with that money. They don't know how to protect it. They don't know how to put that money to work. Or maybe they're so focused. Like this is very common with a lot of doctors that I work with, and sometimes even attorneys as well, but especially doctors. They make a lot of money, but they really don't understand money. They don't understand investing. So they end up going the traditional route of a stockbroker, or putting their money in stocks or indexes or mutual funds or things like that. And I'll show you here right now how that just doesn't really work anymore in this country. So it seems like no matter what or some situation somebody's in, if they've never learned about finances and learned about money and gotten a financial education, they're kind of floundering out there right there. So it doesn't matter what side of the aisle that you're on right now. What's important is that you're here, and these strategies and these techniques I'm teaching you right now will work for anybody. Okay. And just to clarify, I'm not selling you anything, guys, here tonight. So through the Money Multiplier, you will never give us a dime. And I'll talk more about our business model as we get going here. But everything that we do, all of the trainings, the phone calls, helping you guys create your own privatized banking systems and accounts, you'll never pay me a dime. So nothing that we do here is selling anything. And I just wanted to make that very clear, but it is about solving your money problem. And that's what this is all about. And Will Rogers really says it best. See, Will Rogers says the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So I want you to really think about that as we get going here tonight, because what I'm going to do is I'm going to show you guys how to become the 5%. Now, what do I mean by the 5%? If I was to take everyone that's on this webinar right now, and again, I'm used to kind of speaking in front of stages. We've done the Zoom thing ever since COVID and all, which is great. I absolutely love it because I can reach a lot of people doing these Zooms from all across the country, and I don't even have to leave the comfort of my own home office. But what I'm talking about by the 5% is if we do marketing, for example, and we market something, right? About 5% of people will take action. If you present somebody with an opportunity, about 5% of people are going to actually take advantage of that opportunity. Well, what we find in life is if you take, and this is coming from the Social Security Administration, if we take 100 Americans right now in the United States of America, and we look at them at retirement age, or when they wanted to be at retirement age, only 5 out of 100, so 5% of Americans are going to be able to retire the way, the lifestyle that they want to and when they want to. Now, we live in the richest country in the world with the most opportunity that's ever been out there, with more knowledge and information flowing, things like these free webinars that you can get on and learn about financial education. So why are 95% of Americans still struggling to get ahead? And we found that there's a number of reasons why this happens. And I wanted to talk about those briefly because it's important to understand what's going on right now to understand where we need to go, right? Would you guys agree with that? So what we found is, why aren't more people successful? So I wanted to hit on these 6 main topics. Again, this is from 14 years of doing this. From 14 years of not only my own successes and failures, but 14 years of studying financial education, of working with some of the top minds, people like Robert Kiyosaki I've worked very closely with, people like Tony Robbins, people like Chris Nagel that I just mentioned. And I could go on and on with these names, but this is from years and years of experience of me out there doing it, learning it, and then teaching it to others and hearing your experiences and where you are. And what we found is these 6 are the main reasons. Now that I broke them up into 50-50, okay? So the top 3 have to do with financial education and things that I can teach you. The bottom 3 have to do with you. Once you learn how to solve the problem that these 3 top issues create, it's then up to you to take action, eliminate whatever stopped you in the past from doing things, and actually do it. Take advantage of these opportunities and take advantage of these knowledge. Because you can learn everything in the world, but if you don't take action, then what's the point, right? You know, somebody told me one time, they said, you know what, if books and tapes alone, if you could just read everything and become super successful, well, guess what? Librarians would be millionaires, right? It takes more than that. It takes somebody that's willing to help you, somebody to take you by the hand. And then it takes you to actually say, okay, let's do this and let's take action and let's implement what you've learned. So keep that in mind as we go here today as well, because we're going to talk a lot about taxes, inflation, and volatility. And right now, in the last year or two, this stuff is more relevant than it's been in the last decade, since 2008. Because what are taxes doing? Going crazy. Why? Because the debt and the spending is through the roof. You got to pay for it somewhere. Inflation, we all know that's a headline thing right now. Volatility, that's what I was talking about when I started, with the stock market just going crazy every single day. So that stuff will kill wealth. That's what we call the wealth killers. Okay. Those bottom 3 are things that we'll talk about as we get going. And there's one video that I want you guys to watch on mindset, because I'm huge on mindset. I'm huge on reading and always improving and always learning new things. And before you can learn something new, before you can read a book and really internalize it, you have to understand how the mind works a little bit and how to open up your mind to these new concepts. Because we've been beat our entire lives to think one way. Invest in a 401k, go work a job, get a pension and hope it's there for you later. All this stuff we've been told our whole lives, right? It just doesn't work. Again, the Social Security Administration tells us so. So what am I talking about with this video right here? I don't have time to play it. It's an 8-minute video, so watch it afterwards. Go on YouTube and type in the backwards bicycle, the backwards bicycle. And this video right here, all this guy did is, it's really cool. It's 8 minutes long, but he took a bicycle and he reversed the way that the handlebars work. So when you go to turn one way, like you've done your entire life when you ride a bicycle, well, guess what? The bike turns the other way. And it's really funny to watch him and other people try and ride this backwards bicycle. And then they get into a little bit of the science behind it and why it happens that way and how our minds work. And it's fascinating stuff. It's beyond my comprehension. I can talk to you all day long about money and investing, but things like that are just wild. So watch that video, the backwards bicycle, and it's really fascinating. And then once you're at that point where you understand, how to start opening your mind, then let's start taking in books and understanding concepts. And the more you can hop on these webinars, the more education you can get, the better. And audiobooks these days are a great way to do that as well. So these books that I'm going to share with you right now are some of the books that talk a lot about what I'm teaching you here tonight, Becoming Your Own Banker, the infinite banking concept. So the book by Robert Kiyosaki, Second Chance, was an awesome, that book gets all into this concept right here. And anything by Robert Kiyosaki, if you're new to financial education, the Rich Dad, Poor Dad series, can't recommend that more. Just an amazing book and series, and the cash flow quadrant's really, really amazing. So I could go on and on with Kiyosaki stuff, but a really great place to start. If you've never read it before. Anything by Tony Robbins, also very, very good. But Tony wrote all about infinite banking in his book, Money, Master the Game. That's a really good one right there. R. Nelson Nash, known as the godfather of infinite banking. This book right here, Becoming Your Own Banker, is pretty much our Bible when it comes to becoming your own bank. If you ever talk with Brent Kessler, you can literally like name a page number and a paragraph, and he can almost read it to you verbatim. Like it's amazing. It's pretty funny sometimes. I'll mess with him, but that book right there, you got to read it. It's one of the best ones out there. So definitely check that out. Here's a couple more. Mapping Out the Millionaire Mystery. This was an updated version of Becoming Your Own Banker that Brent and Chris actually wrote together. So we'll send you, we'll mail you a hard copy of this book for free if you just pay shipping and handling. So definitely do that if you want a hard copy. But any of you that are on here right now, I'm going to give you guys a free digital copy of this book right here, as well as this one, The Private Money Guide, that starts getting into private money and how money works. Another book that Chris wrote. So I'll send you free digital copies of both those books if you guys want them. All you got to do is go to this link right here, put in your name, email, and phone, and then it'll instantly send you all that stuff right there. And again, more importantly, it'll give you my call calendar, so you can go ahead and get a call scheduled with me, and we can talk. Again, I'm going to be gone, so if you want to talk before the next week or so, just text me, and we'll figure out a time to connect and talk. So there's my phone number right there on the screen as well. All right. So who am I one more time? My name's Stephen Nagy. I was a financial advisor, fully licensed, Series 7 and 66 and all that stuff out of college, and then learned about entrepreneurship and real estate investing, and have been doing that ever since. So have been around this world for 15 years now, trained thousands of people across now all 50 states. And I do own and operate a couple businesses. That's my wife and my now 6-year-old son on the screen. Just, I look at that picture. Time flies, right, guys? I mean, it's pretty amazing. And let me put that link in the chat box for you guys too, just so you have it. So it's moneyschoolrei.com/Snagy, SNAGY. People refer to me as Snagy. All right. So enough about me. If you guys want to know about more of me, I am an open book. Just log on to any of our webinars all the time. I'll talk about myself, or let's hop on the phone. I'll tell you anything you guys want to know. But more importantly, this is about you. So let's talk about money for just a second. Money it's one of those things where when you start asking people, like, what is money? Right? I mean, put it in the chat box, especially if you're new. Like, what is money? What do you think money is? And money, kind of growing up is always one of those things where it's like, you don't talk about money. You don't ask people how much money they make. You don't talk about how people, ask people, how they save or what they have in their retirement accounts. You don't talk about people about money, right? But I don't really get that. I don't get why. I mean, maybe keep things personal, like how much money you make. But when you talk about like investing, especially if it's something that can help other people, like why not talk about it? Because at the end of the day, James, a tool, Todd says options or choices. and the holographic mind, kind of hits it right in the head right there. At the end of the day, it's just a medium of exchange. It's a means of exchange. It's let me take this dollar, let me take this crypto, let me take this silver coin, let me take whatever it is, let me exchange it for whatever I want, right? A good or another service. And that's all money really is. Right now, the dollar bill is the reserve currency of the world, and that's what we use as money. But that could change one day. Who knows? So at the end of the day, money's not a mystery. It's just a means of exchange. And once you start getting rid of these mysteries, it makes a lot more sense. We joke around sometimes about how powerful compounding interest is. Einstein said, compound interest is the eighth wonder of the world. Those who understand it use it. Those who don't pay it. But at the end of the day, companies don't even use compounding interest. It's one of those things where we should be using compounding interest. And I'll show you tonight how to start getting compounding interest for your wealth for the rest of your lives. But it's something that companies don't typically take advantage of. So let me ask this question. Are your dollars worth more today or in the future? And of course, they're worth more today. This is what's known as inflation, one of those top three wealth killers that I was talking about before. What your dollar bill buys you today is going to buy you less next year, buy you less the following year. And we talk a lot about this on our other webinars, how inflation just has killed the dollar over time. And you guys all know it. What did you pay for gas when you started driving? What did, simple things cost back then, So, the dollars are always worth more. So why, and I'll come back to taxes, but why would you wait to eat bread or drink milk? Like, why would you go to the store? So I ask this, like, what do you know about your retirement accounts? So many people are putting money in 401ks. When you put money in a 401k, you're not paying taxes on it today, but when are you paying taxes on it? When you withdraw the money at retirement age. So for me, I'm 39 years old. Retirement age is, technically 59 and a half years old for a 401k before I get penalized for pulling my money out. So I'm deferring paying taxes on that money for 20 years. Well, if taxes are going up, if inflation is always going up, like, what am I doing? Right? Why am I doing that? So maybe we should start looking at, toning down some of the money we're putting in our 401k. I talk to people sometimes that are putting 10, 15%, but their company's only matching 6%. I'm okay with the 6% if they're matching it, but why are you putting all that more money in there, deferring something that is doing nothing but going up and up and up and up? Remember, we're in over $30 trillion of debt in this country right now. We're spending like there's no tomorrow right now. Somebody's going to pay for that, and it's going to happen through taxes and through inflating the dollar. So just think about that. And this is stuff we can talk more personally about when we schedule a call and we talk together. But what do you really know about that? And I could talk about 401ks, IRAs, Roths. I can talk about this stuff all day long. So if you guys want to talk retirement accounts again, and we do have solutions for those as well, self-direct. All right. That's not what tonight's about, but we do train on that all the time. So here we go. Let's talk a little bit more about the mysteries of money, okay, and how money flows. So here's a simple question. Can you make money? Can you earn money while earning 4%? Can you make money earning 4% while paying 6%? What do you guys think? Yes or no? So if I'm only earning 4% on my money and I'm paying 6%, can I still make money? What do you guys think? Yes or no? All right. So holographic mind saying no. Anybody else want to tone in on this? Jeff and Todd are saying yes. So let me just give you guys a quick example. Let's say I wanted to buy a car. It's $25,000. I have $25,000 sitting in my savings account right now. Let's just say that it's a really cool bank because that bank is paying me 4% interest on my money sitting in the savings account. Okay. So I have money at the bank right now earning 4% in my savings account. I go to the bank right now and I say, okay, I'm going to withdraw my $25,000 because I want to go buy a car with it. And then the banker there says, hold on a second, Stephen, how about I give you a loan to go buy that car, a loan for $25,000, and we use your $25,000 that's sitting in your savings account as collateral. So that way the money can sit in the account, continuing to earn 4%. And we'll use it as collateral. And then I'll give you a loan to go buy that car for $25,000. And you can say, okay, well, that sounds good. How much are you going to charge me for the loan? And the banker says, well, you're going to pay 6% on that loan. And you say, all right, Mr. Banker, I know your dirty tricks. These guys have told me that bankers are always going to try and make money. So no way I'm going to pay you 6% while you're paying me only 4% on my money in my savings account. I'll just take it out. And the banker says, no, 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 you don't get it. Hold on a second. Let me show you what I'm talking about. So this is what happens. And you guys can do this with a compound calculator, but I did the math for you. So what we're going to do is we're going to take out a car loan over 5 years, right? That's a pretty common car loan, right? Over 60 months at 6%. So we're going to listen to the banker. And here's what happens. It's a $483.32 monthly payment, because when you take a car loan, you got to make that monthly payment, right? So here's what happens. Over the 5 years, paying 6%, that $25,000 for the banker is going to grow to be $29,000. However, the $25,000 sitting in my savings account only earning 4% over the same 60 months, 5-year time span is going to grow to be just over $30,500. So what just happened there? We just made $1,500 by paying the bank 6% while they paid us 4% in our savings account. Now, how does that work? Why does that happen? Well, it's depreciating reduction of principal over here, because as you make these monthly payments, what is happening? That $25,000 initial balance is depreciating, right? Over here, the $25,000 that's earning 4%, what is that money doing? It's compounding year after year after year. So when you have compounding occurring, you can actually make more money while earning less than while paying more. And this is going to be important. The reason I'm showing you this is because this is going to be important when I start showing you how to become your own bank and warehouse your wealth in a vehicle that has uninterrupted compounding interest, because you're going to have uninterrupted compounding interest while simultaneously pulling that money out to use it for other things. So we'll talk more about that as we go. But at the end of the day, I just want you to remember this. We're able to make money while paying a higher rate than what we're earning. Okay. So keep that in mind as we go. So what is the money multiplier method? It consists of 3 parts. Number 1, the machine. This is the vehicle that we're going to use to warehouse our wealth. Number 2 is the marathon. And number 3 is the millionaire. So the marathon means this is going to take time. Okay. This is not like a slot machine at Vegas where you can put some money in and become a millionaire if you get very, very lucky. And this is not some kind of like get rich quick machine where I tell you to put some money in there, and all of a sudden you're very, very successful and all this stuff overnight. No, it takes time and it takes effort on your part, and it's a process. Okay. The product, the machine, is a lot less important than the actual process, which is this marathon. So we'll talk about that. But I can promise you, if you use this machine properly and you follow this process and run this marathon with me, you and someone in your family, your legacy that you're creating, you all will become millionaires. Okay. It's as simple as that. You will create the success that you want. And that's what this is all about. So let's get into this a little bit. What is this machine that I talk about? What is this magical vehicle that you're going to start warehousing your money in? Well, it's plain and simple. It's a dividend paying whole life insurance policy from a mutually owned life insurance company. That's it. And that's the beauty of it. Now, a couple things on this right here. First off, just because this is a whole life insurance policy does not mean it's a whole life insurance policy that's off the shelf, that any insurance agent, your uncle, your friend, we all know life insurance agents, right? It's not something that they're going to be doing for you. All right. These are very specially designed and engineered whole life policies that we build day in and day out, specifically and only for privatized banking, for becoming your own banker. Okay. So let me say that one more time. This is not something you're going to call your insurance agent and get. This isn't something you're going to call the insurance company and get. This is something that we are going to specially design and engineer specifically for you for privatized banking purposes. Okay. This is what we do all day, every day. We build these policies, we work with clients, and we do the infinite banking concept. If you want to look at like if a financial planner is kind of like a doctor in the overall like general medicine, we are very specialized surgeons when it comes to building these policies and what we do with the infinite banking concept. Okay. So the beauty of it is at the end of the day, it's just a whole life insurance policy. Whole life insurance policies are simple. They're easy. They have guaranteed growth. They're not an investment. They're very, very safe. They're risk-free. Did I mention guaranteed? Do you know, as a financial advisor, as a broker, saying the word guaranteed is a no-no. You can never use the word guarantee in things. Well, guess what? With this, I can. And that's the beauty of it. Okay. And we're going to talk about what this machine looks like and how this works right now. But I just wanted to be very, very clear on what this is, who does this, and who you're going to talk to help me. That's why I said you guys are going to want my call calendar. You guys are going to want to know how to schedule a call with me, because you're going to want to hop on to be able to talk about your situation and get this set up for you and your family. Now, what I want to do also is bring up something called BOLI, B-O-L-I, bank-owned life insurance. And after this, what I want you guys to do is go on to Google and type in BOLI, B-O-L-I, BOLI, bank-owned life insurance. And what you'll find is banks are the largest purchasers of whole life insurance in the entire country. Banks. Why do banks buy whole life insurance? Well, before I answer that question, did you also know that banks love real estate? Think about where banks are located. Banks are all across the country. There's Wells Fargo's like every 2 miles when you drive down the road. Think about in major cities, all the big, beautiful, brand new skyscrapers. Many, many of them are banks. We were just in Palm Beach, Florida. I was with Chris and Brent and Devin and a bunch of other people that are in this space a couple of weeks ago. And we were driving through down Palm Beach on our way to a culinary tour. And guess what? When you're driving past Worth Avenue and you get to downtown Palm Beach, guess what all the big, beautiful buildings are that are up and down the road right there? They're all banks. And everybody was like pointing it out from the limo that we're in. Look at that. Look at that. There's another one. There's another one, another bank. And they're just naming them one after another in brokerage houses. And so when you look at what banks do and how banks invest and where banks' money are, the two places, M1 money supply for banks, whole life insurance and real estate. Whole life insurance is number one. Real estate is number two. Do you think that banks know how to make money? Do you think banks understand how money works? So if banks are buying whole life and banks are buying real estate, do you think it's something that we might want to be in ourselves? And this is why these are the two strategies that we focus on and that we teach. We teach real estate. We teach private money lending. We teach active real estate. It's what we do in money school. And then we teach whole life, especially design and engineer through the infinite banking concept. This is exactly what we do with the money multiplier. And that's why, because we mimic and we imitate what other successful individuals and what other successful institutions do. Plain and simple. So check out BOLI whenever you have a chance. Now, who else has used this strategy throughout history? How about Jim Harbaugh, Michigan football's head coach right now, but very successful football coach. You guys can check this one out. This was from November of 2016. What most people don't know, however, is that the compensation strategy was designed to provide Harbaugh with millions of dollars of tax-free cash during retirement. It's one that can also be incredibly effective on a much smaller scale. And they talk all about right here how he used cash value life insurance to create a lot of deferred compensation for himself. And there's a lot of business leaders that are starting to do this right now as well. How about Joe Biden? Holds 4 checking accounts. And somebody told me this the other day. They were like, they came out and was like, he has $600,000, but how much is he really making? So, he holds 6 life insurance policies with Mass Mutual. Mass Mutual is one of those mutually owned life insurance companies that we do business with on a daily basis. Who else? How about Walt Disney? When Walt was, after failing in his pursuit of traditional means of financing to build what would later become Disneyland, Walt decided to provide his own financing. A large part of this came to be by collaterally borrowing money from his cash value life insurance. The Pampered Chef, Doris Christopher, $700 million operation started from her Chicago home using a life insurance policy, money that she borrowed from it. Ray Kroc started McDonald's. In 1961, he bought out the brothers, Kroc did not take a salary for the first 8 years. And to help with cash flow, he borrowed money from his 2 cash value life insurance policies to help cover salaries of key employees, as well as the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers. I could go on and on and on and on. Again, we just mimic what very successful institutions and people have done throughout history. So let's talk a little bit about the banks, because to understand how this concept works, again, we have to figure out how money flows. And the best way to see how money flows and how your money needs to start flowing through this policy to do the infinite banking concept, let's just mimic what the banks do again, okay? So if you were to take $100,000 right now and you had $100,000 cash, first off, what are your options? Well, most people, if they need the money for something coming up, they're going to go down to the bank. I mean, I guess you could stick it in your safe or under your cushion or something like that. But most people are going to go down to a bank and they're going to put the money in a checking account or a business account or a savings account or something like that, right? So let's just say again that this bank is going to give you 4% on your money. Well, that bank doesn't just take that $100,000 and let it sit there. That bank's going to take that money and they're going to immediately put that money to work. And again, this is what you need to start doing with your money. Keep this in mind, okay? This is all a lesson right now. So your 4% that you're making, the bank is then going to take that $100,000 and they're going to lend it out to somebody that wants to buy a house. And let's just say they're going to charge 7%. Now I know mortgage rates are closer to like 5.5%, 6% right now, but I also know that a savings account is paying more like 0.5% right now. So again, these numbers aren't important, the specific numbers. It's more this what's called the spread. So this is what we're going to operate off of, is the spread, okay? And that's what's important. So this home loan right here, they're going to charge the person 7%. So that home buyer takes that money, they give it to the seller. Then what's the seller do with that money? They put it right back in the bank, right? And then let's say that, okay, they bought a house. Now they need a new car to park in the garage. So the bank says, we'll give you a car loan at 8%. They go down to the local car dealership. They buy that car. The car dealership puts it right back in the bank in the business account, right? Then they say, okay, well, now we need to remodel this house that we bought a few years back. Go to the bank, 9% loan. Then maybe get in some debt consolidation loan at 12%, pay off the credit cards. Credit cards put that money right back in the bank. So what just happened there? Well, the bank made 3% spread, right? They're charging 7%. They're paying you 4% of that 100 grand. They made 3%. Then they made 4% spread on that car. Then they made 5% spread on that home remodel loan. Then they made 8% spread on that debt consolidation loan. So they just made a total of what? How much did they just make off your money? 20%? Is that right? How about 500%? Think about it for just a second. They are paying you 4%. They just made 20%. How much is that? That's 5 times more than what they're giving you is what they made. 5 times the amount is 500%. So think about this for a second. Don't take my word for it. Go to Bauer Financial after this. Bauer Financial. Bauer Financial is a site that researches banks and puts out information on banks. They're like a reporting agency on what banks do and how banks operate and things like that. And they say banks make between 400 and 1,300% on money that you leave there. So let me ask this question. Why are you doing that? Why are you giving all your money to the banks? Why are you putting your money and making them rich? Because let me ask it a different way. If you owned a hair salon, where would you go get your own haircut? At your hair salon, right? Or if you owned a restaurant and you had friends in town, where would you take them to eat? At your own restaurant, probably, right? Or if you own a gym, you ever go to a gym where the owner's a part of it? They're always there, right? Because why would you work out somewhere else? Well, if you owned your own bank, where would you do all your banking? At your own bank, right? And that's what this is all about. I'm going to assume you aren't doing that now because nobody's ever taught you how to set this up before. Nobody's taught you how to do it. Nobody's taken your hand and done it for you. And that's what I'm here for. That's why I'm going to here to help you guys. Okay. So stop making the banks earn 400 to 1300% off of the money that you leave there. And you start making 400 to 1300% off the money that you're putting in your own bank. Is that okay with you guys? Are you okay with this so far? Is everybody learning something? Are you guys okay with this? Are you following me? Is everybody okay? Exactly. The holographic mind said it perfectly because we've been conditioned to do it our entire lives. And you're absolutely right. That's exactly it right there. So this is how we're going to start recapturing all that money that right now we're giving away to everybody else. This is how we're going to start making 400 to 1,600% returns on money that's sitting right now. So this is how we're going to start building wealth without working any harder, without working any longer, and without taking on any more risk. Okay, let me show you this. So if I was to take a dollar bill, I don't have a dollar on me. I don't have my wallet on me. If I was to take a dollar bill right now, on average in the United States of America, this is how people spend money. Now, you're probably a little bit different, but let me explain on average what goes on. And this will work for you too, because maybe it's a little higher or lower, but this is how money works. All right. So here we go. On average, out of every dollar that you earn, 20 cents, 20% of that, 20 cents goes towards automobiles. For every 30 cents of every dollar that you earn, it goes towards housing. For every 40 cents that you earn, it goes to everything else. So do the math, 40 plus 30 plus 20, what's that leave you with? 10 cents. 10 cents on average is what Americans save. Now, right now, it's less than that. During COVID, it was more than that. So we're not going to split hairs and talk specifics. This is just on average, okay? So let me show you how to start increasing that savings without doing anything different. So if we look at the 20 cents, so we're going to build this backwards just so you guys know, okay? So if we look at the 20 cents that currently goes to automobiles, about 5 cents of that 20 cents goes towards interest. The 15 cents goes to payments or insurance or whatever, but 5 cents of that 20 cents on the automobile goes towards interest. Okay, so what we're going to do is we're going to take that 5 cents and instead of giving it to the bank or giving it to the car finance company or BMW or whoever, we're going to give that 5 cents to our bank. All right. We're going to pay ourselves that 5 cents instead of somebody else's bank. So we're going to give it to our bank. So by doing that one thing right there, what did we just do? We just increased our annual savings by 50%. 50%. Because we were saving 10 cents before, now we're saving 15 cents. That's a 50% increase in savings by just recapturing the interest you're giving away to other banks anyways right now, okay? Let's look at mortgages and housing. Did you know that out of every 30 cents that is spent on housing, 25 cents of it goes towards interest? Now, how is that possible? Because if we take a 30-year amortized fixed rate mortgage, which most people have 30-year fixed rate mortgages, right? If we take that and we look at it, about 90% of the interest that's paid on a 30-year fixed mortgage is paid in the first 7 years. Did you know that on average in this country, somebody is going to sell their home and get a new mortgage, that damn due on sale clause, right? So somebody's either going to sell their home and get a new mortgage, or they're going to refinance their house on average, you guessed it, every 7 years. So if on average in this country, we're moving or refinancing every 7 years and getting a new mortgage, and about 90% of interest is paid in the first 7 years, do you see why 25 cents out of every 30 cents is going towards interest? So how about we start recapturing that money back to our bank and stop giving it away to other banks? And then if we look at everything else, that 40 cents on average, about 5 cents, although with credit cards going up right now, it's probably more than that, but 5 cents on average of everything else goes towards interest. So let's go ahead and recapture that as well. So by doing that right there, we just increased, let me see, 5 cents on the automobile, 25 cents to 30 cents, and another for 35 cents. We just increased our savings from 10 cents a year on every dollar up to 45 cents by doing nothing different, just where our money is going and whose money we're using when we do these purchases. Okay, that's it, plain and simple. And I'll show you exactly how we do that right now. All right, so how do we start getting all the money back for every car you'll ever buy, drive, and own for the rest of your lives? So before I show you that, let's take a little look under the hood. Now, not under the hood of that Mustang, but under the hood of this policy. So over on the right here, this is a whole life insurance policy, what's called an illustration. The illustration is going to show the year of the policy, the age of the person. We'll talk about this in a second. These are what are called premiums that are going into the policy. This is when we do a money multiplier illustration, we break all this out for you. And I'm going to show you what this looks like in just a second. But you're going to have a death benefit on the policy, and you're going to have what's called the cash value. The cash value is the amount of money that's available to pull out of the policy via loan that you can use for infinite banking, you can use for purchases, that you can use for paying off debt, that you can use for whatever. Okay, that's what's known as the cash value. So this is a little look at what a money multiplier whole life insurance illustration looks like. Now, a couple things on this. First off, you'll see how I have deposits right here. These are really premiums. So when you start a policy, when you start a whole life policy, you're going to determine how much you want to put into the policy on an annual basis. And you can pay into it monthly, quarterly, biannually, all up front each year. That's up to you. That can change annually as well. But you're going to decide. I'm not going to tell you. You're not going to say, well, I want $1 million in death benefit. What's that going to cost me? No, I'm going to say, how much do you want to put into this thing? Now, as a guideline minimum, we don't want you to put like $100 a year into it. There's no point in doing that. We want to build our banking system, right? So as a guideline minimum, what I'm going to tell you is to start with, let's say 10 times your age on a monthly basis. So if you're 39 years old, let's say 40, so that's $400 a month, okay? About $5,000 a year. So that amount or more would be a good starting point. You want to put $10,000 a year into this thing. You want to put $100,000 a year into this thing. You want to put $3 million a year into this thing. Awesome, let's do it. That's completely up to you. You're going to tell me. But more importantly, we want to stop looking at these as premiums, because if you have to go pay a premium, I don't really want to do that, right? But if I get a check right now for 100 grand, I'm going to be excited to go deposit that thing at the bank, right? So am I going to get excited to go deposit that into my own bank? Absolutely. Just because it's a premium, I don't want that to take away from the fun. So I'm going to start referring to this money going into the policy, not as premiums, but as deposits. Are you guys okay with that? Can you start doing that for me? Let's refer to these as deposits from this point moving forward, okay? Number two, age doesn't matter. This was a 26-year-old on this policy. I started a policy last year for my son that was 5 years old. Chris started one for his daughter when she was 6 months old. We do them for people in their 20s, their 30s, their 40s, their 50s, their 60s, and even their early 70s, okay? Now, if you're 80 or 90 years old and you want to do the infinite banking concept, or maybe your health isn't the best or something like that, we have solutions for you as well. Do it on a kid, do it on a grandkid, do it on a business partner, do it on a spouse, do it on a friend. We have solutions for that stuff. So the age does not matter. Also, the death benefit, we don't really talk about it, but it is there. But more importantly, so Jeffrey is saying the quote is for ultra preferred. You mean preferred. So you guys are talking about health ratings. The health ratings aren't going to affect the cash value and how the policy works for banking as much as they're going to affect the death benefit. So somebody that's older or maybe not in as good of health, they're going to still put the same $10,000 a year into that thing. So they're still going to have the money available in cash value to pull out and use it for banking, but their death benefit might be a little bit less than what somebody that's super healthy or super young, that same $10,000 a year going in, they're going to have a higher death benefit on that thing, right? So that's where that part comes into play. But at the end of the day, again, the product is not as important as the process, because when you're warehousing your money in this vehicle and it's still compounding and growing for you just the same, the rest of that stuff is irrelevant, okay? So that all of that goes into it. And again, this is stuff that we can talk about personally when we hop on the phone and get into this a little bit more. All right. So here we go. So let's go ahead and let me show you how you can start getting your money back for these cars. Okay. So again, going back to that policy, $10,000 a year going into it. That's what they decided they wanted to do. In the third year of this policy, they decided to buy a vehicle for $25,000. So there's where you see that $25,000 purchase. The cash value is how the policy grows as the money compounds and as the deposits go in. When you take a loan from the cash value, the death benefit of the policy, it reduces that cash value shown right there. So we go out and we buy that car. Now, if you were going to buy a car and get a loan from the bank, again, you're going to repay the bank, right? So we're going to teach you how to recapture that money and pay your own bank back, pay yourself back the same way. So in this case, we decided to pay ourselves back $500 a month or $6,000 a year. So that $6,000 car loan payment is now coming back to our bank instead of somebody else's bank. So what happens is over 7 years, we put $70,000 into this policy. We spent $25,000 and we've recaptured $30,000 for a total of 100 grand minus the 25 of 75,000. We bought a car for $25,000 that we still have sitting in our driveway. We have $67,000 in our banking account in our policy available for the next use. And we had put a total of 75,000 in. So what this shows me is I have put 75 in, I have 67 available, so a total of 91%. And I have the $25,000 car sitting there. So I haven't quite recaptured 100%, but I've recaptured, 91% of it, right? But it doesn't stop here because this policy doesn't stop compounding here. So let me keep this going, all right? Now, in this example, we stopped putting money into this policy after the 7th year. In reality, when we talk, you're going to see there's no reason you would ever want to stop doing this because every year that you have this policy, this bank, it's becoming more and more efficient. And that compounding aspect, that money in there, compounding uninterrupted, guaranteed, it doesn't stop. Okay. And every year that compounding becomes stronger and stronger and stronger. So you're going to wish you could put more money in during these later years, not no money, but just for this example, I'm going to show you how this works, even putting no more money into this thing. Okay. So let's say in the 8th year of this policy, we want to buy another car. So now we have 2 cars sitting in our driveway. We start recapturing the money over the next 5 years, just the same. We put no new deposits in. We recaptured 30,000. We spent 25,000 from our policy for a total of 23,000. So from the 67 to the 91, it grew by 23,000. We net injected $5,000 into this thing. Okay. So it grew by 23,000. We net injected 5,000. We have 91,000 available for our next purchase. And we have 2 $25,000 vehicles now sitting in our driveway, bought and paid for. So I have 2 cars sitting there. I have $91,000 in my policy. I'd say that we just recaptured all of the money that we spent for those 2 vehicles in the first place. You guys see that? So let me ask you this question. There's 3 rules. Well, let me say this. There's 3 rules that we have to abide by for this to work. And then I'll ask you one question. So number 1, always pay yourself first. Okay. Always pay yourself first. That 10% you're saving now, that $400 a month, go to this, whatever it is, always pay yourself first. Number 2, pay yourself with interest. If you're going to give the bank interest and you're going to borrow the money from your bank, pay yourself interest as well. Number 3, always recycle and recapture your money. And we're going to teach you these 3 rules, okay? I'm going to talk more about what's called our mapping team in just a second. But when we talk on the phone, I'm going to start teaching you this stuff. And then once the policy is in force and you go to our mapping team, they will not only put a map in place for you, a plan that I'm going to show you in just a second, but they're going to start teaching you these rules and these banking principles so you can do this over and over and over again for the rest of your life. And again, we don't charge for any of that stuff, but those 3 rules are very important. And here's the question. If this works for cars, what else? What else can it work for? What other kind of major purchases in your life? Appliances in your house, a swimming pool, a boat, an airplane, maybe more real estate, right? And we'll talk about investing in just a second as well. So let's talk about debts now for a second, because I told you I was going to show you how to pay off debts quicker while continuing to build wealth. I told you to show you to recapture money for major purchases like cars, which I just showed you right there. And then we're going to get into the fun, which is the millionaire, which is building wealth and investing in business. So we're going to end with that. But before we get there, let's talk about debts. Anybody have debts on here? Check this out. So Mark was asking, at what point can we buy the car out of the policy funds? Great question. You can take your first loan from the policy, so you can pull money from the cash value in that policy within the first 30 days. Okay. Within the first 30 days, you'll take that loan, that money, and you'll have it back available to use to purchase a car, to pay off debt, or do whatever you want to do with it. Okay. So within 30 days. All right. And if you guys have more questions, put them in the Q&A. I don't want to miss stuff in the chat box. The chat box gets going pretty quickly sometimes with comments. So put those questions in the Q&A and I will be sure to answer those as we go here. Okay. All right. So this was a chiropractor that Brent was working with. And this chiropractor had a lot of debt. Okay. They made good money. Like I said, doctors and chiropractors and, people make good money, but then they spend the money, right? They start racking up that debt. And this chiropractor found himself in a position where he had a total debt of almost $500,000 in third-party debt. And we did the math for him. It was almost $70,000 a year he was paying out, and almost $6,000 a month. When you add up all these monthly payments, it's almost $6,000 a month. And if he was to continue on the plan and just paying this the way that it was supposed to be, it would have taken him almost 19 years to pay off all this debt. And Patrick, if you put in less than 10,000, no, 10,000 a month, I'm talking about 10,000 a year, first off, Patrick, but you can put in, again, whatever amount you want to, no problem. All right. So here we go. So here's what we did is we created a policy for this chiropractor where he wanted to put in $25,000 a year. So on this policy, he puts in $25,000. He has about $15,000 in cash value that he can borrow right back out to start tackling this debt with. Now, let me say something real fast on this. The policies that we design right now, because of some rule changes that happened with the IRS back in end of 2021, beginning of 2022, and just because we're now able to design higher cash value policies, we can get you much higher cash value on that $25,000 immediately. But I always like to under promise and over deliver. So let me show you how powerful this is, even with only 15,000 of that initial 25,000 available right away. All right, so check this out. What we did is we took that $15,000, we immediately paid off the Discover card, we immediately paid off the Lowe's card, and we reduced the balance on that Nordstrom card. All right. So we eliminated those payments right there. However, we want to recapture this money back to ourselves. So what you're going to want to do is, instead of paying $5,777 a month to all these third-party debtors, we want to start recapturing that money and paying ourselves back. So we're going to keep that $5,777 monthly payment, but what we're going to do is we're going to reduce how much goes to other people, and we're going to start recapturing that money ourselves. So now we're not paying Discover Card and Lowe's $448 a month. We're paying our own bank back $448 a month, and only $5,339 to third-party debtors. So here we go. So year two of this thing, $25,000 goes into the policy. Now we have cash value of that $25,000 of $16,500. Again, the cash value is going to be higher and higher and higher and higher every single year for the rest of your life because of compounding, uninterrupted compounding interest. Now, these payments we now have available, this was that $448 a month that we're paying ourselves back. So what we're going to do, this $448 a month is going to go into what's called a segregated bank account. A segregated bank account is nothing more than a checking account at a bank. Okay. We're going to use banks for our advantage. So we're going to put that money in there, but it's not going to sit. We're going to continuously get that money out of there because, again, we don't want the banks to be rich. We want to be rich. So we're going to put it into there. We can flow it back into the policy. Again, we'll map all this out for you. This is the circle of how the money flows, and I'll show you that in just a second. But that $448 a month is going to go into that segregated bank account. Now we have $5,300 available to deploy to pay off more debt. So when they take the cash value from that deposit into the policy and combine that with the recaptured money from the year before, we now have almost $22,000 to use to tackle debt. So what are we going to do? Pay off the Nordstrom, pay off the Wells Fargo, pay off the private loan. And then we're going to take those payments, bring them into our segregated account. Now we're down to $3,800 to third-party debtors and almost $2,000 a month going back to ourselves. You guys following so far? See what's happening? So same thing in third year. 25 goes in, cash value goes up to 25,000 now, 23,000 in recaptured payments, a total of 48,000 of cash. That way you can start tackling stuff. So we pay that off there, the BMW, pay off the West Marine card, reduce the balance in the condo. 3,600 we're recapturing and 2,100 going to third-party debtors. This is just in the third year of this thing. So let me quiz you guys before we go on. Let me make sure you're following me. So in the first year we put in 25, the second year we put in 25, the third year we put in 25, a total of 75. We took out $55,000 during those 3 years. So if we put in 75 and we took out 55,000, how much is left in your policy? How much? What do you guys think? Let me make sure you're following. 75. I told you we took 55 out. How do we have 75? All right, the holographic mind, 20,000. Anybody else before I show you? All right, so the first three, I got to tell you, holographic mind, they've been on past webinars because we don't have 20,000 left in our account. We actually have 75,000. So let me go back for just a second. When we put that 75,000 into our policy and we start taking that money out via loans, we're not taking our own money out. We're leaving the money in our policy and we're using it as collateral. And we're actually borrowing the money from the insurance company's general account. And that's what allows our money to remain in the policy, compounding uninterrupted for the rest of your life, even when you're pulling all that money out and you're using it for other things. So that whole 75 is still in there, compounding and growing for you, uninterrupted, even when we pull all this money out. So fourth year of the policy. So 25,000 goes into this thing in the fourth year, same thing, same drill. We reduced the condo, but the payments didn't change because we didn't actually eliminate the condo. So there's still a monthly payment. We just reduced the balance. Year 5 of this thing. So here we go. Reduce the condo. Now all we have left is the house. Year 6 of this thing, year 6, something happened. All right. So in this policy, this guy was putting in $25,000 a year for the first 5 years. But because of the way the policies were designed, now this usually happens after the 10th year in modern policies, but this policy is like 7, 8 years old. So in this one, the amount that he was able to put into the policy dropped from 25,000 in the 6th year down to 10,000. So in the 6th year of this policy, that original policy, he can only deposit $10,000 into it. But notice right here, how when he puts in 10,000, he has now $13,000 available in cash value. Not bad. That's a 30% return, cash on cash return on his money in the 6th year of this policy. But this chiropractor, he didn't want to only put $10,000 into his banking system. He wanted to start putting more money into his banking system for a total of $35,000 a year. But because of MEC limits and how whole life insurance policies work, he is only allowed to put $10,000 in. He can't put 25, he can't put 35 in, only 10. So what's the solution for that? Open more policies. So this is how we start building our banking system. We start opening additional policies whenever you have more money than will fit in your first policy or your second or third or whatever. Whenever you have more money that you want to put into it than it will hold, you just open another policy. And that's how you start stacking policies to build your banking system. So his first policy is now able to put 10,000 in. His second policy started back at $25,000 a year. So 13,000 in cash value available on that one, 14,000 available on that one, plus the recaptured payments of 55,000 from down here. total of 82,000 in cash value. In the 6th year of this policy, we're going to take that $82,000. We're going to pay off that house. And we have now eliminated almost $500,000 in third-party debt in 6 years. Now we have $5,777 in money that is now being paid back to our bank. And all of that interest and all of that money is now remaining within my family's financial future and my family's legacy forever, instead of giving away to all those other people. So did you guys like how we did that right there? And we will do this for you too. If you have debt, it's what we call our debt map. So I mentioned our mapping team earlier. They're the ones that are going to map this out for you. They're like a GPS. If you want to go somewhere, you put in your GPS. Where are you now? Where do you want to go? It takes you there in the fastest way possible. That's what our mapping team does with you. They're going to look at all of your debts. They're going to look at all of your income. They're going to look at all of this stuff. They're going to look at your cash flow. They're going to talk to you about, what that looks like on a monthly basis. And they're going to create this plan for you to tackle it just like we did for that chiropractor for your situation. And again, we do all of this free of charge. You're not going to pay us a dime for any of this stuff. Okay. We're going to do it all for you. And that's what we call our map. And that's how we're going to make sure that you're doing banking and taking full advantage of this stuff moving forward. All right. So let me ask this question. When it comes to the millionaire, what if you don't have any bad debt, or what happens after you pay off all that debt? What if you don't need a new car or make any major purchases right now? Can you still benefit from privatized banking? Should you still become your own banker? Hell yeah, because that's when the fun begins. Let's start building wealth and creating a legacy. So before I go on to that, let me answer just a couple questions. I saw some questions coming in, so I want to answer these questions for you guys. So Andy's asking, is this resume recorded? It is recorded. And if you email me, Andy, I will send you the recording. So my email is snagy, snagy at the money multiplier.com. All right. Lynette's asking, so I have about 7,000 in credit card debt that I have the cash from all the money the government kept giving us. Would it be better to just pay it before they charge me interest, or pay back my policy with that money, then take out another loan? Yeah, Lynette, Lynn, I would definitely get with your mapping agent so they can look at your overall banking picture and what your policies are doing right now, the cash value. But I would 100% run the money through the policy first. Absolutely. Let's recapture that money. So Mark's saying, so we wouldn't be able to buy the car at the same time as the example. Yeah, you would. The example is exactly right. In the 3rd year of that policy, they had 25,000 in cash value available. So they pulled the money out to buy the car. If that's not what you're asking, let me know and I can clarify. Stacy's asking, why does the money need to go into a segregated account? Why not just pay a drag? So Stacy, it can't, so she's saying, why use a segregated account? Why not pay the money directly back to the policy? And you can do that. You don't have to use a segregated account. What you'll find over time is that it really helps with accounting and tracking purposes. And when you pull, when you take a loan from the policy, you put the money out to use, you're going to eventually, you're going to want to look at that circle being completed. Now, from the account back to the policy or back out to the next use, that's kind of personal preference, and the mapping team can kind of help you strategize and the best way to do that. So at the end of the day, you don't have to, but you got to understand, Stacey, a lot of people also have multiple policies. So if you're taking loans from 5 different policies and you're not using something called a cash value line of credit or a collateralized line of credit, which I'm not going to get into too much right now, but you're taking loans from all these different policies. It makes it easy when you can go look at the checking account and see which policy the money came from, how much you borrowed, when you borrowed it, how you're paying the money back. So it kind of helps, especially as you grow your banking system. So you don't have to use a segregated account. We're always going to teach you best practices. This is how we do it. This is what Nelson Nash teaches. And this is the best practice for infinite banking. If you want to do it, awesome. If you don't want to do it, no worries. It doesn't matter. You're in control. So do it however you want. So Todd's asking, can you open a group policy and investment fund to improve the fund yield while ensuring? Todd, let's talk about that. That's a little bit more complicated than right now. Can you do this for most of the loans online or have to contact you guys? So Jeff, you can take loans yourself. The insurance company gives you your user portal, your client portal, just like any insurance company does. You can log in. That's what I do. I just three clicks, boom, 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 and request a loan, and you're off to the races. So you can take loans yourself. You can call the insurance company, go right online and do it, or you can have the mapping team do it for you. It's up to you. All right. So Jeff, I don't want to miss your questions. Put them in the Q&A box, please. So I'm going to keep rolling, get those put together in the Q&A box, and I'll answer them here in just a few minutes. We're only going to go maybe 10 more minutes, and then we're going to wrap things up here. All right. I want to respect everybody's time, and we did get started just a few minutes late. All right. So let's get back to this for just a second here. All right. So the millionaire, creating wealth multiple ways. So this is stuff that once the debt's gone, once the purchases are done with, these are ways that we use our policies to build wealth. So I'll give you a couple examples. And if you're not familiar with any of these ways to build wealth, please watch our wealth webinars or join us for a Money School Essentials 3-day training that we do. So Chris and I have been putting on Money School 3-day trainings for over 2 years now. We just went back to doing them live in person, as well as we're going to continue to do them virtually. We have a hybrid option coming up in Buffalo, New York at the end of July. So please join us for that. Actually, I'll put the link in the chat box. But what we do at these 3-day trainings is we teach you all of these subjects, and we bring in experts to teach you all of these subjects. So join us for one of our 3-day trainings if you want to learn more about this stuff. But just to give you an example, I can take money from a policy to do a flip. And Devin Burr is really good at teaching the Burr strategy. So if any of you guys are doing the Burr strategy or doing a lot of flips or even long-term holds through the Burr strategy, you got to either watch one of our recorded ones or come to one of our 3 days that Devin is at. And he teaches this concept better than anybody else when it comes to using that along with the policy. But commercial property, I'm a big fan of. Apartment complexes. We do a lot of private money lending through what's called the Private Money Club. So I can lend my money out all day long right now at 12, 15%, have it secured, buy real estate, buy a hard asset, just like a bank does. So I'm doing the same thing a bank does. I'm taking my money from the policy where it's compounding and lending it out. I'll give you an example of that in just a second. Business owners, my wife and I just bought a new business. It's a franchise. We paid for it with money from a policy. So I'm borrowing money from my policy to expand my business portfolio. My goal over the next 10 years to have 12 different businesses that I'm not running. Other people are running, but I have benefiting me. You can do stocks and options trading. We do a lot with notes and note investors. Crypto might be a good time to buy. So, and we're also doing a lot with precious metals right now. I don't know why I don't have this on here, but a lot with precious metals. And I actually teach a webinar on Thursdays about precious metals. So join us for that if you want to learn more about gold and silver. But lots of different ways to create wealth. And this is all stuff that we can do, with our policies. So when it comes to creating and growing wealth, compounding interest, I've been talking about it over and over again. Number 2, keeping money moving. This is very important. So those different ways of building wealth, it all entail keeping money moving. So money sitting in a policy is compounding and growing, great. But that money is going to sit in there and compound and grow whether I'm using that money or not. So let's take the money from that policy and let's get that money moving. Let's look at where our money's going. Again, how much are we putting in 401k? How much do we have sitting in checking or savings or business accounts? Let's get that money in moving. When I have money sitting in one of my accounts, I start getting anxious because I need that money moving for me. I know that money's not doing anything for me, just sitting. So keeping money moving is very, very important. And that's what this is all about right here. So let me show you a very passive way. No time to do this stuff. It's not hard to do. Let me teach you a very passive way. And this is what we call private money lending. Okay. So this is an illustration I did for a 41-year-old. This was a female. This was just maybe 6 months ago or so. So she wanted to put 150,000 in the first year and then 50,000 a year after that. So notice right there, we can put a lot more money in these policies the first year, even 2 years if you want to. Okay. So let's say you just did a real estate deal, or let's say you just pulled some money out of the stock market. Let's say you cashed out of something. Let's say you took money out of some real estate, a lot of equity right now in real estate. So now it's just sitting there, right? Let's dump that into a policy, but maybe you don't want to do, $2, $3, $400,000 a year. Maybe you only want to do 20,000, 10,000, 50,000 a year, right? Well, let's dump that larger sum in there up front. Let's jumpstart the policy. I mean, look at this. Of that 150,000 she puts in the first year, she has access to 132,000 of it. I mean, it's not all of it, but it's a lot of it. So dump it in there and start that uninterrupted compounding interest. And then I'll show you over time how this thing grows. I mean, look at it in the 13th year of this thing. She puts $17,000 into the policy. Look how much it grows by. Almost $50,000. Her 17,000 she puts in grows by $50,000 in the 13th year. So you'll make up for that little bit that you're missing out on the first year very, very quickly. But let's get that money in there. It's what we call a dump in. All right. Here's the second one. They wanted to put $50,000 in up front, but then only $6,000 a year. But they didn't want to put $6,000 a year. They wanted to put $500 a month in. So they dumped 50 grand in and then immediately started putting $500 a month into this thing. And you can see how this thing grows over time. When they're 67 years old, the 30th year of the policy, they're getting 400% cash on cash returns. I mean, it's just crazy. Yeah, James is saying he's about to dump a refinance into a second policy. Love it. All right. So here's real fast the flow of money. So here's the TMM policy. This is the insurance policy. This is the whole life. So you pull the money out, just $20,000, $30,000 in that example, goes to that segregated account. Now, when you pull money from the policy, anywhere from 3 to 5%. From there, they did a 12% private money loan. You recapture the monthly payments from that loan. You keep the profit, which is known as the spread. Again, the spread, which is that 4% to 12%. So you keep that 8% spread. The rest of it's recaptured back to the policy. So you can do it over and over and over again. And remember, all this money is sitting in there compounding and growing for you. All right. So here's an example. Let's say they wanted to do a private money loan in the 8th year of this policy. So the 8th year of this thing, they put $50,000 in. It grows by $66,000. That's a 37% cash return on our money. Okay. You guys see that? If I put 48,000 in and it grows by $18,000, you do the math, 48,000, 18,000 growth. That's a 37% cash on cash return. I got to put my money somewhere, right? So I'm either going to put it in my bank or I'm going to put that 50,000 in the traditional bank. Then I take that money and I do a private money loan at 12%. So my money grows 12% that year through the private money loan. My money grew 37% within my private bank. I paid the insurance company 5% to borrow that money to do this private money loan. So I just made a 44% return on my money. Do the math. 37% plus 12% minus 5% is 44%. Let's take the alternative real fast. I was to put my money in a traditional bank, earning 0.5% in a savings account. I take that money out of there to do a private money loan at 12%. Now that money is earning 0, right? When you take it out of savings, it's earning 0. I made 12% of that private money loan, but I didn't make anything in my savings account or that money otherwise. Here, I'm making 12% in that private money loan, plus all the compounding within my policy. So we did nothing different except where the money goes first. I'm putting it in my bank instead of their bank. So let me ask you, would you rather make 12% or 44% of your money for doing nothing different? I took on no more risk. I didn't do anything longer. This was 1 year time span. I did nothing different. This is the power of becoming your own banker. You guys starting to like this stuff? And by the way, the death benefit is tax-free, creates a legacy for your loved ones because all that death benefit that was on there, it's going to go to your beneficiaries tax-free. The loans never have to be repaid. When you took that car loan from Wells Fargo or from who does car loans? Ally Bank. When Ally Bank gave you that car loan, and then in 2 years from now, you lose your job and you can't make that car payment, guess what? They're going to repo that car. Well, if I borrow the money from my bank and in 2 years from now, I lose my job and I can't make that car payment for a while, am I going to repo my own car? No, I'm going to cut myself a break, right? I'm going to continue paying myself back whenever I can. The loans never have to be repaid. Internal values grow tax-free. Taxes are one of those top 3 wealth killers. We're eliminating the wealth killers with this, guys. That's all we're doing. Let's take advantage of tax-free growth. Policies in most states are exempt from judgments and liens, bankruptcies, things like that. And I didn't even talk about the uses for businesses, how we can start loaning our businesses money, getting a tax deduction and creating income that way, or how we can do company-owned life insurance, COLI, company-owned life insurance to have our company pay for policies. So I didn't have time to talk about that, but let's talk about it on the phone. Make sure you guys schedule a call with me, okay? And we can talk all about that. And then kids policies. I mentioned it earlier with my son, but kids policies are unbelievable for buying them cars when they're 16, for buying them a business, for paying college expenses, and more importantly, for teaching kids money, for giving kids financial education and putting them in a position where they're going to be financially successful when they get to the age that they're financially responsible to take on that. Do you guys like that right there? Because my son, when I started a policy for him at 5 years old, when he's 18, or 20 or 22 or 25, or maybe never. But when he's financially responsible enough and he proves to me that he understands how privatized banking works, I'm going to give him that policy. And then he's going to have his own first bank in place and ready to go at a very young age. And what have I been talking about? Compounding interest. How does compounding interest work? With time. The longer you have this, the more efficient it's going to be and the more compounding tax-free that takes place. It's a beautiful thing, guys. It's a beautiful thing. So why aren't more people successful? Because they let this bullshit get in the way, right? This stuff is nothing more than to keep the 95% in their place. This stuff is nothing more than what stopped you your entire lives. Let's eliminate that. I just showed you how to stop all of this. Tax-free growth, keep money moving, inflation, guaranteed places to store wealth, ways to invest and make money without the volatility of the stock market. I showed you that tonight. This stuff's on you now. You got to take action. You got to go right now and you got to schedule that call with me. And Warren Buffett says it best. If poor people would just do what rich people do, they wouldn't be poor anymore. Warren Buffett's got such a simple way of saying things that makes so much sense, don't you think? So these are the last 2 things I'm going to ask you. You got to ask yourself, while you're alive, are you better off with or without this? Once you pass away, once you graduate, once you die, are you better off with or without this? And you can answer those questions yourselves. But if you think you're better off with it, then let's hop on the phone. Let's talk about your situation and let's get this going for you and for your loved ones. All right, guys. So text me or email me to schedule that call or go to that link right there. I'll put it in the chat box one more time. So not only will you get all the bonus books and everything, but you'll get the link so you can schedule a call with me so we can get that done and we can make things happen. So with that being said, I'm going to stop the recording and I'm going to answer all of your questions for you guys being on here.